The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod on behalf of Gold Money, and with me on the line I have Jim Puplava, whose website is financialsense.com. Jim also manages money for clients, and as such, he's also an expert in things like peak oil and very much involved with the investment scene in America. Welcome to the podcast, Jim.
Alasdair, thanks for having me.
Oh, it's very much our pleasure. As an investment manager, you manage other people's money. This must be very, very interesting times. We have a bond market that where interest rates, or rather yields, seem to be beginning to tick up a little bit. We've had a little bit of turbulence in the equity markets. What's your take on the current situation?
The current situation, I think that probably as we get closer towards the end of the year, I think you're going to see another pickup in the economic cycle from where it is today. Some of the things that we're watching, the leading economic indicators. I mean, on the U.S. side, you have two very strong sectors in the economy, autos and housing. The housing numbers on the day you and I are doing this interview came in much better. And I think that for the time being, one of the growth engines of the world is still going to be the U.S. The only trouble is it's not going to be like it was in the past. We're not going to see the 3 to 5% growth rates.
No, they seem to be set quite a bit lower. I mean, you talk about autos and housing. These are rarely capital goods sectors, aren't they, which you would expect to move first in some sort of recovery?
Absolutely. And, you know, up until the past, if you take a look at Keynesian economics, it was all about consumption. And I think really when you take a look at that, they have the cart before the horse, because it's really about investment. If I am a company, and let's say I make the decision to build a new plant, well, number one, I'm creating jobs because I have construction jobs. I'm building a new factory. Now that I build the building, I'm going to start ordering equipment. So there's jobs in the equipment sector. And then once the factory's complete, I'm going to have to hire workers to work in that factory. Now, all those jobs that are being created in construction, building the machinery and equipment, and then running the factory, that creates jobs that puts money into people's hands that then have the money to spend. And the problem with Keynesian economics, it talks about consumption, and consumption really follows investment. And I think we've got it backwards. And what's been good about this is that the capital goods sector, whether it's automobiles or it's housing, is improving. And I think that surprised a lot of people.
Yeah, no, I think that makes sense. Put another way, basically, auto manufacturers and other manufacturers have to plan a long time ahead in order to produce something that they judge the consumers will want. And they have to employ people to produce those things before they get any money in from selling it. So I think this is perhaps what you're referring to in the sense that the Keynesians have got it wrong. It's never a question of consumption first. There is always got to be investment in the business, and the business has actually got to produce something which the consumers then want. And so have I got your analysis more or less as you see?
Yeah, and we've seen this when you take a look at some of the programs that have come out of the recovery, and this goes back even to George W. Bush. First, they came out with this temporary tax cut. Okay, I'm going to give you a few bucks. The problem is this gets with the consumption theory. Okay, you give me a few bucks, I spend them. Now what? And it wasn't until they actually lowered tax rates, created incentives, and people started building stuff and making stuff, does the economy really recover. And until you do that and can incentivize businesses to go out and, you know, hire new workers, build a new factory, build a new plant, you're not going to get any results. And whatever you do get will be fleeting and short term.
Yes, one sort of slight side issue, which I'd be interested in your thoughts. I think if we were talking about the last 20 years, we would say a lot of the manufacturing, American-owned manufacturing, has been done abroad, particularly in Southeast and East Asia. Do you think that's coming back to America at all? Do you detect that?
Yes, I see two positive things that are happening right now. Number one, a renaissance in American energy. But let me state, when I say renaissance, I don't think America will ever go back to producing over 10 million barrels a day like we did in 1971. But I think we're going through another peak of increased production as a result of shale. So energy costs here in the U.S. are cheaper. Natural gas is cheaper. It's cheaper to ship goods across the country. So if you add the renaissance in energy and you combine that with the renaissance in manufacturing, I mean, if you take a look at Fiat's building a new factory here, Airbus is building a new factory, a lot of the foreign companies are building new factories, and heaven's sakes, even Apple is coming back, and they're going to spend $100 million and build 3 new factories.
That's interesting. I mean, is this as a result of government removing taxes or making it easier to plan to set up a factory, or just spare capacity, or what? I mean, I can understand a European company moving to America because really Europe is so hidebound with regulations you can hardly move. So that I can understand. But there has to be an attraction. Why America, do you think?
I think, well, 3 things. I think first of all, labor costs have been somewhat stagnant, so we're a little bit more competitive, and especially if you take a look at what has happened to the dollar today compared to, let's say, where the dollar was in the year 2000. We're more competitive. The cost of making things is cheaper here. The cost of transporting things is cheaper here. Energy is cheaper here. But I want to put a caveat in terms of manufacturing renaissance, and this goes with a book that is now out about the states by analyst Meredith Whitney, and she's talking about a bifurcated America. So if you look at where Apple's coming back and building a factory, they're not building it in Silicon Valley. The cost, the regulations, the taxation, cost of living is too expensive here. They're building it in Austin, Texas. They're building it in Tennessee. Now, what do those states have in common? Lower cost of living, low taxes, no taxes, less regulation. So that's where I think you're going to see 2 types of states in this country. You will have states like California that will continue to run into problems, and you'll have states like North Dakota, South Dakota, Texas, Tennessee, where the economies are more robust, and it has a lot to do with government policy.
I know it's a slightly silly question, but do you think that California would ever wake up to these simple economic facts of life?
I think eventually, yes, but it's going to take a full-blown crisis, much as the country had to go through in the latter 70s. We got to the point where we had high unemployment, over 10% in 1980. We had inflation at 14%. We were running budget deficits. The economy was suffering from stagflation. Now, we just raised taxes here, and they were made retroactive. So the state is bragging about now they're running a surplus. But let me tell you what every Californian that makes money is doing right now. He's talking to his advisor on either 1, moving, or 2, taking steps to minimize those taxes. So whatever windfall that California got in the short term will be nothing but that. It'll be a short-term windfall because more and more states or companies are moving out of state. We've got governors here from Texas, Nevada, Arizona that have set up shop here to recruit California companies, and they're doing a good job of it. If you look at Austin, Texas.
Yeah. Oh, absolutely. Now, so moving on slightly onto, you touched on the subject of shale oil. Now, this I find fascinating because shale oil has sort of come from nowhere over the last 18 months. Suddenly, everybody's talking about it. Suddenly, you've got God knows how many trillions of gas is going to be dislodged by shale oil, by fracking and all the rest of it. What's your take on the situation as far as the United States is concerned and her shale oil reserves and how they will likely be exploited and how that will affect energy prices as a whole?
I think in the short term, it's sort of like, I call this the third peak in American energy. You know, we peaked in 1971 with conventional oil. And then in 1968, we discovered the North Slopes of Alaska, which were brought online in the latter part of the 70s. So American production increased in the early part of the 80s until I think North Slopes peaked somewhere around 1988 and 89. But even with the increase coming from Alaska, we never got to the levels of production that we did when we peaked in 1971. So I think the shale oil revolution is doing the same thing. We may increase oil production here in this country by several million barrels a day. We've contracted consumption by several million barrels a day. So in the short term, I think this is all a help for the U.S. But as far as the IEA's estimate that, 10 years from now, 20 years from now, the United States is going to go to becoming the world's largest exporter, I just don't buy that. I think it's a short-term benefit that has definitely helped to bring the cost down for most Americans here. I mean, if you take a look, of course, in Europe, you find more of the cost of gasoline has to do with taxation. But, I mean, we're paying $4 at the pump in Europe. It's got to be what, $8, $9, $10?
Oh, it's huge. I mean, I don't even like to think about it, Jim. No, you're absolutely right. But is this shale oil? Is this very expensive? I mean, we know what it's like in Arabia. You just basically have a pump and it just sort of flows out, and you don't have to do a lot about it. But shale oil does take quite a lot of energy, I think, to get it out, doesn't it?
Yeah, I mean, it costs a lot more to produce shale oil. That's number one. And number two, the shale wells are very rapid payback, but they go into production decline rather quickly. Within 2 to 3 years, you're all of a sudden going into production decline, so you have to drill another well. So it's more costly to produce, and it's one of the reasons why, if you look at gasoline today, I'm looking at an average here by AAA of $3.71. Why are we paying $3.70 in, let's say, 2013 when oil on West Texas Intermediate is only about let's call it $98, and Brent's at $105, compared to, let's say, the summer of 2008 when we got up to basically almost $150 a barrel. And the reason is it costs more to produce. If you take a look at conventional oil peaked, when I say conventional oil, that's sticking it in the ground, kind of like what you were referring to in Saudi Arabia, or poking a hole in the ground. And you take a look at tar sands is more expensive to produce, deep water is more expensive to produce, and shale is more expensive to produce. So I think what we're going through is something the guys at CERA, that's Cambridge Energy Associates, talk about, the undulating plateau. That with new alternatives and declining conventional oil, that will reach a peak around 2030, and we'll just stay there for the next several decades as new supply comes from undiscovered oil and alternatives. I think what we're getting right now, McAllister, is that very undulating plateau, because that's my petro-business cycle. Whenever economic growth heats up, as it usually does, as stimulus is applied to the economy, what happens? The demand for oil goes up, the price of oil goes up with that, inflation goes up, and all of a sudden the economic numbers begin to roll over again. If there was all this oil out there, then why can't they bring the cost of oil down? And the fact is, all of this unconventional oil that we're getting, whether it's shale, deep water, or tar sands, is more expensive to produce, which is one reason why you and I are paying more for gasoline today.
Yeah, it's sort of good news, bad news, isn't it? I mean, the bad news is that oil is going to remain expensive. I mean, whether it's more expensive or than today or whatever is a matter for debate. But at least we are going to have oil supplies for considerably longer than we thought maybe 5 years ago, when the debate about global warming and all the rest of it really took off. One suspects partly because governments could see the train wreck of an energy crisis arriving, and they wanted to push us all into renewables. Do you think that was a factor, or am I being slightly cynical?
I think they saw that. I mean, you don't want to scare the population and say, hey, someday we're going to run out of oil, so we got global warming and we need to go into clean renewables. And the problem, McAllister, is that, if you look at the transportation system, it's basically a liquid fuel problem. When you get in your car, you put a liquid fuel in it. We call it gasoline. If you run a train, most trains run on diesel. You take a look at trucks, you take a look at boats, you take a look at airplanes. The transportation system runs on liquid fuel. And I think what we should be doing is trying to move our transportation fleet to electrification, like you have in Europe with the train systems, and I think eventually here with cars. But that takes time. I mean, the transportation fleet, I think, has an average age of about 9 or 10 years. I mean, you're not going to wake up tomorrow with government policy and say the entire United States is going to turn in their cars. We're all going to be driving electric hybrids.
Yeah, that's always quite a difficult one, actually, too, getting people to switch from the personal convenience of their own motor car to public transport. I mean, is that? Do you think that's the way forward in America for transportation?
Yeah, and I think the Tesla model is something that I think may be paving the way. They haven't quite worked out. They're coming up with charging stations. The problem with rapid charges of batteries, you wear out the battery life. So I think you're going to have to go to a system if let's say the average American spends no more than 50, 60 miles driving to and from work. If you can get electric hybrid that gets 75 to 100 miles on a charge, so you go to work and you leave the car in the parking lot, you do your honeydews after work, you come home, park it in the garage and plug it in. But in order to move in that direction, we're also going to have to start building more power plants. Yeah. And so it's not just that we're going to need a new form of, let's say, instead of a gas station, maybe a station where you pull in with your electric car and you change batteries and then you drive off. I think that's a more workable model.
Yeah. You mentioned power stations. I mean, I know from the experience in the UK, the lead time in planning these things is absolutely enormous. I mean, you're talking about 15, 20, 25 years. Does it take that long to respond in the United States to changes, if you like, in energy demand patterns?
I think it could be speeded up, and usually what speeds it up is a crisis in pricing. It's the marketplace coming to work. When consumers start paying $5 and $6 a gallon, they get angry, and they reflect that anger at the polls. And so that's what gets the politicians' attention, is an angry voter. Yeah. And until the voter is angry, it's like this whole thing with the sequester in the airports, where all these flight delays. Well, that lasted about a week because they heard from the voter. Yeah, and I think it's going to be the same thing with, whether we're looking at the Keystone Pipeline, where we know we could bring down the cost, and it gets bogged down in politics. It's not until it starts hurting the bottom line of the voter that the voter wants to watch TV. They want to watch Monday Night Football or America's Got Talent or something. They're not as long as their life is not being interrupted, they could care less. It's only when it becomes inconvenient they get concerned.
Yeah, I understand that totally. I feel exactly the same. Now, changing the topic slightly. We're going through a bit of demand for capital goods, and that's usually a forerunner for some sort of economic recovery. And economic recovery generally leads to, a pickup in consumer demand, and that leads to a pickup in inflation, and it leads to a pickup in interest rates and all the rest of it. How do you see that panning out? I mean, we've got this sort of slight uptick in interest rates already. Do you think this is the harbinger of the end, if you like, of zero interest rate policy? What's your take on it, Jim?
I think we're going to begin an upward climb in interest rates, and I do believe that interest rates bottomed last summer when the 10-year Treasury note got down to 1.38. Today, we're looking at just slightly over 2%. But these interest rate cycles are long-lasting in nature. I mean, the last one we had began in the mid-1950s, and it peaked around 1981. Well, if you look at 1981 until the summer of last year, that was a long cycle of declining interest rates. Right now, McAllister, what we have is a situation where let's say the U.S. budget deficit this year will be somewhere between 650 to 675 billion. Well, if you take a look at what the Fed is doing with QE, they're monetizing 600 billion of the 675. and then foreign central banks are picking up the rest of it. So one of the reasons that we have not seen a spike in interest rates, a good majority of sovereign debt is being absorbed by sovereign central banks. So what this has done is pushed institutions and individuals into further out on the risk curve. So you have junk bond yields that are somewhere around 5%, and I read recently investors were even buying the bonds of Rwanda. So
yes, that's right.
yeah, so you're pushing people further out on the risk curve as sovereigns in sovereign central banks are buying most of the debt. Now, that will last in the short term, and I hearken back to the 1970s when Nixon took gold backing of the dollar in August of 1960 or 71. The interest rate on the 10-year Treasury was at 6.8%. Now, despite all the money printing, despite the inflation rates, Gerald Ford's whip inflation now, interest rates were contained within a narrow channel of 6.8 to, let's say, 7.8 from 1971 to 1977. But in 1977, something happened, and that is the bond vigilantes woke up, and they said, no more. If you're going to keep this inflation, we want to be compensated by higher interest rates. Well, right now, there's enough disinflationary forces in the global economy and financial markets that we haven't seen the big rise in interest rates. I think it's coming, but I think it's down the road.
Yeah, that's interesting because the way I look at it is that the money that has been printed through QE basically hasn't entered the economy except in, through the normal channels, let's say, government providing welfare and so on and so forth. And all around the world, we have this effect that so far it seems to have got stuck in this in the securities system, the financial system, and mostly apart from what she was saying about motors and a little bit of residential property development, it hasn't really sort of gone very much into capital goods yet. So there's quite a wave of money, I think, waiting on the sidelines in a sense. And interest rates, it could sort of disrupt it. It's a difficult one to call, I think.
Yeah, because, the Fed has created a lot of money. The Fed's balance sheet will be about $4 trillion, but much of that money still resides at the Fed. As you mentioned, it hasn't worked its way out into the marketplace, and even when it comes to real estate, and even though the real estate market has improved, and we're seeing building going on again, but it's a different real estate market. It's the lenders actually want to see tax returns. They want to see a down payment. They're not going to believe you if you say I drive a cab and I'm making $250,000 a year. They're not going to buy that story like they did in the last decade.
Memories are too short, too long, if you like.
Yeah, so they're at least they're looking for down payments. The lending is more rational. However, if this continues further, we could see some of those speculative juices come back. There was an article in the Wall Street Journal last week. CDOs, these collateralized debt obligations that were part of the problem in the credit crisis. Well, Wall Street is back to its tricks again. There's a demand for them, and so now they're starting to come out with CDOs. So as you see more of that kind of behavior, what I would look for is a lessening or loosening of, let's say, lending requirements, which would loosen things up and more credit gets its way into the economy. But right now, memories are still there from that 2008 crisis, and even though the stock market is up 150%, we still have money. I think in the fourth quarter, $300 billion went into money market funds. So investors are, institutional investors are certainly going into the market, and they're making investments because the market's up, double digits again this year. But a vast majority of the money that has been created resides at the Fed. It's still there.
Absolutely. And some stage it's going to come out. Changing the topic yet again, what's your feeling on gold? We've had a very, very dramatic few months with the smash down in April. Demand seems to have taken off all around the world, yet the prices still remain low. How do you see the gold price developing, Jim?
I think it's going to take the catalyst. And right now, the gold takedown in April, my interpretation of it is there was a lot more stories coming out of central banks who are saying, we want our gold back, whether it's Switzerland, Ecuador, places like Venezuela or Switzerland or even Germany. And as more and more of that gets out, then gold is going to get scarcer. And those who have been part of the gold carry trade, which is the bullion banks, they've gone out and they've borrowed. How are you going to cover that gold? I mean, you've sold that gold short. You're making money on it. You take a look at gold lease rates. I could buy, an average S&P stock or a Dow stock and make 5 or 6 times my money. And so the problem is, you had all these bullion banks in the month of February and March come out with all these newsletters predicting gold at 1,100, 1,200, a lot of it just nonsense. But nonetheless, they were trying to create this panic. The only problem is the only way that they're getting their gold or trying to cover is getting it from the ETFs. And that's only going to last so long because as they drive the price down, we've seen these lines in India and in Asia where people line up. When the price goes down, it's like putting something that you want on sale. And so this is only going to work so long. And the other thing is there was a study that came out, I think a little over a week ago, that 95% of most gold companies have a cost structure that's higher than the current market value of gold. Now, that's a problem, Alasdair, because if you're producing gold at $1,500 and the current market price is $1,400, you're losing not only over $100 an ounce for every ounce that you produce, but now you have to go back and replace that ounce you produced at a loss, and it's more expensive to replace it. So this can only last so long.
Yeah, and a lot of these companies, I think, have a problem insofar as they need capital to be able to continue, and with their ratings, their share ratings at the moment, it's almost impossible for them to raise any meaningful money on economic terms.
No, and the junior resource sector, because of regulations, because of high-frequency trading, naked short selling, investors have exited the sector. So, and this was where all the real exploration was taking place. The other theory that I also have is in the last probably 2 decades, in the 90s when we were in a bear market, companies consolidated. So you had companies like Newmont and Barrick become bigger companies. They also, to remain profitable when gold prices were low, is they used their high-grade ore. Now what they have left is low-grade ore, which is more costly to mine and has a lower margin to it. But they also got in this what I call megalomania. It was all about how many ounces of production and reserves, and they went after these big projects that were I call them the elephants. It was kind of like they were looking for another North Sea or North Slope of Alaska equivalent in gold, and where they found them were in politically unstable parts of the world. And these projects have turned out to be more costly than they thought. You've had governments that have been more greedy coming in, raising the royalty rights and saying, now that you put this mine in production, you remember that deal that we had? Well, we think we need to change it. And so I think they're going to have to get more realistic. Instead of going after elephants, there's probably a lot more million-ounce projects out there that are economic that could a company would be better off lower capital spending, lower operating cost, lower acquisition cost, and the smart companies are doing that. You see this being done by companies like Agnico Eagle and Yamana, who are investing in this sector because they see the opportunity. But the big guys haven't got the message yet.
No, I think that's I detect that as well. I'd now like to, as a final question, lean on your experience as an investment manager. You've seen cycles, market cycles of all sorts, equities, commodities, and so on and so forth. And I think you will have been around long enough to be able to judge the sentiment in a sector and to know where we are in the cycle of things. Now, with respect to precious metals, do you feel that this is a moment when the professionals should be fishing around in the bottom, or have we got more to go on the downside? How do you see where we are, if you like, as a fund manager, but using your fund manager's cap in this cycle? How do you see it, Jim?
I think we're certainly low enough in this cycle that you can begin to do some fishing, but your choices of where to fish are very limited at this point because a lot of these companies haven't gotten religion yet. You've seen some of the CEOs replaced at this company, some of these companies, but you have to look at companies that really get it, that are good at mining, very good at making acquisitions, very good at keeping their cost under control, are very regional specific. They have mines and areas and jurisdictions that they feel comfortable with in terms of political risk and what I call economic law. They feel confident that what they own they're going to be able to produce and it's not going to be confiscatory. So I think you can go fishing, but where you can go fishing is very limited at this point.
And as always, when you're fishing in these markets, you've got to be very careful what sort of fish you land, I guess.
Yeah, you don't want to buy something that you overpay for and then find out they missed their earnings target, their cost structure is much higher than it originally told you. And then, those are the kind of things that cause investors a lot of pain.
Yeah, absolutely. Well, Jim, thank you very much indeed. I'm very grateful for your time, and I'm sure our listeners will also enjoy this podcast. And just to remind them, your website is financialsense.com. Is that right?
That's correct.
Excellent. Well, thanks again, and hopefully we'll do this some other time.
Thanks for having me.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.